Hi viewers, I'm your host 𝗧𝗯𝗹𝗲 HIH and we are back with another video. In this video, we'll be talking about accounting for the non-accounting professionals. Once I say non-accounting professionals, of course it means all professionals other than those with the accounting background. But in this video, our focus will remain be on the IT professional. So now your question may be that why only on the IT professionals? So our answer is very simple, that because IT professionals face huge problems during the development of the accounting related projects. Even though the other professionals like the sales and the management and the operations should also have the accounting knowledge to do their work easily. But in the IT side, they are facing a lot of problems with the non-accounting knowledge. For example, some companies needs to hire consultant who possess knowledge of the accounting as well as of the basic programming knowledge of the IT or of that particular software which they intend to implement on their client's location. So what that consultant do? He gathers all the information from the client, understand their requirement or understand that gather information and communicate to developer so that it becomes easier for the developers to customize the software. The consultant do this easily because he has the knowledge of the IT side too, so that he translate the gathered information easily into IT language for developers or for the IT professional. This video will help these IT professionals or even other operationals and the sales professionals to understand the gathered information even without the role of the intermediate consultant. So guys, let's jump into the core accounting side and see how it works. Let's talk about first what is accounting. So that is a total theoretical thing, but just quickly have a look at that what basically the accounting is. So accounting is the system of recording and summarizing business and financial transactions and analyzing, verifying and reporting the result. It means that collecting basic information and then process it in such a manner that you present the end result in shape of report after verifying the gathered information. This we are discussing you to give an idea of the accounting only. Now let's see that what different basic terminologies we use in the accounting. This is very important to understand because if you want to gather information of any field, any particular field, first of all you need to have a basic terminologies ideas of that particular topic. So like the same we will try to understand that how the different terms are using in accounting, and this will help you to understand the reporting and the further accounting easily. So let's understand first what is debit and credit. Debit and credit is just a basic accounting terminology which you can say that it's only a left or the right side of the transaction. Sometimes people misunderstood and considered that when there is any increase it's a debit and a decrease in the transaction or in the amount is a credit. Wrong, totally wrong. On the later stage of this video you will understand that why we are saying that it is wrong. So you have to watch the video completely to understand that why this concept that the increase is always a debit and decrease is always a credit will explain it to you in the later stage. Now our second term is stock or inventory. Inventory is anything which you have at the end of any particular period of time for the purpose of sale. Anything which you have or which you retain at the end of any particular period. Inventory can be of raw material, it can be of work in process, or it can be of even finished goods. The companies retain separate stock for each of these categorized stock. These terminologies like raw material, work in process and finished goods is used mainly for the inventory purpose. So raw material, as it is self-explanatory that if you are manufacturing any product, So its raw form is called its raw material. So of course you should have an uh, idea of those things which you kept it as a raw material with you. So how much material which you have, and how much you can convert it into the finished good from the raw material. You should have an idea of that. Second thing, work in process. So from the raw material you have started the process. Even though you have started the process, that hasn't been converted into the finished goods. So that number of stock is also important to keep it in the company. And finally it is the finished goods. So finished good is the one which we basically the output you were targeting, and finally you have got it. So mainly we keep the stock of the finished goods in most of the companies, but in the manufacturing sector you have to have an idea of all these categories of the stock or the inventory. But in the other sectors like like trading or any other one, you will have an stock or inventory of the finished goods only. In those sectors you will not find work in process or the raw material. Next is sales and purchase. So sales means selling of the stock, and purchase means purchasing of the inventory or the stock. So to qualify for the definition of the sales or purchase in accounting, remember that the item which you are selling in sales or buying in purchase must be the inventory item. So just make it underline that it must be the inventory item. Selling or buying of any other thing other than of inventory will not be considered as sale or purchase. That may go into other income in terms of the non-inventory sales, or assets or expense in terms of the non-inventory purchases, but you cannot term it as a sales or purchase. So for example, if you are buying anything, like for example if you are buying for the furniture for your stock, you cannot consider it as an inventory. Or for say you are buying a newspaper for your company for a daily routine purpose, it is your expense, but you cannot categorize it into the inventory. So you have to be very particular once you say that what is inventory and what is non-inventory. Then our next term is asset. So once you say assets means that anything that has current or future economic value to a business, which means that anything which in present or future give you financial benefits, or which helps you in earning financial benefits. To understand it further, let's understand its subcategories. Assets are further subcategorized in current and fixed assets. Current assets we refer to as anything which gives you benefit within 12 months, or which can be encashable within 12 months. So remember another underlying point, that which gives you benefit within 12 months, or which is encashable within 12 months. So anything which you can convert into the liquid asset, mean that anything which you can convert into the cash within 12 months, you will term that one as a current asset. The examples of the current assets are cash in hand, cash in bank, prepaid expenses. Prepaid expenses, of course we'll discuss this one in a little while. Any advances which you have made to the employees, or even the stock is also the part of the current assets. Why? Because the stock you will convert into cash normally within 12 months. It happens very rarely that the stock you retain for more than for 12 months, but normally you can keep the stock, you sell the stock within the 12 months. This stock or inventory is same which we have already discussed just few moments earlier. For the stock or for the inventory purpose, we actually use different accounting methods to record it, or for the recording of the cost. For example, like FIFO, LIFO, average inventory. So we use different methods for the calculation of its cost actually. Similarly, fixed assets, and the second category is actually for the assets is the fixed asset. So fixed assets are those assets which provide you economic benefits for more than 12 months. Now the underlying or the remembering term is for more than 12 months. So anything which have a benefit of more than 12 months, you will record it under the fixed assets. So normally the tangible things have the qualify for this, like vehicles, your car, building, the one which you have, maybe you have an office for that, or maybe you have the building and you have rented for rent. The computers which you have, the laptops, the PC, the furniture. So all those things will come under the fixed asset. But remember, the fixed asset can also be intangible, like goodwill or the patent. You have a goodwill, that so that goodwill, the amount of that goodwill will come under the in the fixed asset side. So we're just a while ago we're talking about the inventory. So the related topic of the inventory is also the cost of the goods sold. Now, once we say cost of goods sold, or in some sectors it can be the cost of sales also, it means that the inventory or the stock which you have sold, what was the cost of that. Now, calculation of the cost is bit tricky. Why it is bit tricky? Because first of all, as I have said earlier also, that you have to use different methods, like FIFO method. FIFO mean first in first out, LIFO method, last in first out, or the average inventory method. So it depends. Like similarly, there are methods with the periodic and the perpetual inventory also. So it depends on that. But as a layman right now, or as a basic accounting professional, you can understand that anything which you are selling, how much it cost you. So just take an example. For example, you buy one pen for 1 dirham, and for this particular one pen, as an average, you have given the transportation of 20 fills. For that, you have spent a labor of 10 fills on that, and you made some the other miscellaneous expenses of the 20 fills also on that pen. So the total cost of this pen will become 1 plus zero point 0.2 plus that 0.1, and then 0.2 become 1.5. So it means that your cost, if somebody asks you that what is the cost of that pen, you will say 1.5. You will not tell only the purchasing cost, you will tell the cost including the other expenses. This cost which you are telling including the other expenses is called the landed cost. So normally it happens in the trading one, which you are when you are importing the items, and then you are recording it. You do not only record the purchase in the purchase value, you also include or added the import cost, like for example the custom duty, like for example the freight cost, like for example the transportation cost. So all these have to be added in that stock to get it into the landed cost. So I hope that this must be making a sense to you. Next one in our list is the prepaid expenses. We have already spoken about the prepaid expenses just a while ago. So let's discuss in detail right now. It's very easy to understand. Any future expenses which you pay in advance is called prepaid expenses. You may say advances in layman terms. Rent pay in advance, or for say rent, if you are paying rent in advance, the rent say for 3 months, it is the prepaid expenses. Some even the salaries you are paying in advance, that is also the prepaid expenses. Next one in our category is account receivable, or we also use the term of the debtor for it. Debtor means that the amount which is receivable from different customers. Normally only those amounts fall under the category of account receivables which was generated from the sale of the stock. Any other receivable amount which does not relate to the receivable from the sales itself will not fall under the category of the debtor. The underlying word. What is the underlying thing? That to qualify for the account receivable category or the debtor category, this receivable must be from the sale of the inventory. and not from the sale of any other thing. Even though it will remain be receivable, we will not keep that under debtors category. For example, you have given the loan to any of your friend, or you have given the loan to any of your partner in the company. This loan will not become under the account receivable part, even though that will remain under the current asset side, or you can say receivable from others, but will not hit this one with the account receivable. Accrued is another important term. To understand the category of accrued, first we need to learn, or first we need to identify that the word accrued is used with the expenses or the income, or you can say that we need to learn to identify that the word is used with expense or with income. So if the accrued is used with the expense, then accrued expense will mean expense payable. But if accrued is used with the income, then accrued income will mean income receivable. So it's a little bit tricky, but you have to understand the above explain basics, then you will not mix it up. For example, if you say that accrued salary, now salary is your expense, so it means salary you can also refer to as salary payable. So in this example, salary payable or accrued salary, both are the same thing. Similarly, I have I'm doing the company is doing the commission things also. For example, we are providing the services and we are taking the commission on that. Now let's say we have already provided the services, but we have not received the commission so far. So I can say accrued commission. So accrued commission mean commission receivable also. So as I already said to you that in which means you are using it, it depends, and then on the same purpose you can categorize it. Next one is accounts payable. If you have already understand account receivable earlier, then this concept is peanuts for you. Only difference in account receivable and accounts payable is that in account receivable we consider any amount which is receivable from different customers and pertain to sales of the stock, while in accounts payable we consider any amount which is payable to supplier. Obviously, we consider that amount only accounts payable which is related to the purchase of the inventory only. Any other payable amount will not be fall under accounts payable. Of course, that will remain be considered as payable but not accounts payable. Like for say we have already discussed before also that for say that we have to pay to outside. For example, we have acquired the services for any agent and we have to pay to him. Now we cannot say this one, technically we cannot say accounts payable for this guy. We have to say payable to others, but it will not come under the accounts payable. The another term which we use for the accounts payable is creditor. Next one is capital. Capital simply means investment of the owners or the shareholder. So anything with a shareholder or investor investing in the company is termed as the capital. One more term which we use in accounting is retained earning or accumulated profit and loss. It means accumulating of profit or loss of all previous years or sum of all previous years profit and losses, and that's why we consider this one as a retained earning. To make you clear the concept further, let's assume an example. Company X earned profit of $50,000 in 2019, profit of 30,000 in 2020, and a loss of 10,000 in 2021. So if you sum up all those profit and losses, so the ending balance of retained earning at the end of 2021 in our books will be 70,000. How you reach the 70,000? 50,000 profit plus the profit of the 30,000 minus the loss of the 10,000, so you reach to 70,000. So that is basically the retained earning at the end of the year. Now see what is bad debts. This in this one, the spell is DEBTS, but this B is silent. Sometimes people call it bad debts, but that is basically wrong. It is bad debts. Bad debts mean debts which are bad. To make it clear, it means any debts or receivable which you which you considered as unrecoverable. For example, you make sale to Mr. Y of $15,000 and that company declares insolvency. It means there is no chance to recover that amount, so we'll consider that amount as a bad debt. We also use the terms of the provisions. This term is actually used to keep some future estimation. Or we can say that provisions are the funds set aside by a business to cover specific anticipated future expenses or other financial impacts. For example, future estimated loss in inventory or in account receivable. We also use the term of provisions in accounting, which you can say is same as we use in our normal life. We have covered almost all the basic terms in this so far. I hope so that there is no further basic terminologies left. If there is any, we'll discuss later in this video again. So now let's see what are the major head of accounts and how we categorize that. So there are total 5 head of accounts which we categorize the whole accounting transactions. So for the whole accounting transactions, we are dividing into the 5 head of accounts. So what are the 5 head of accounts? So the first one is assets, which we have discussed earlier also, but we'll see in the little bit detail now. Second one is liability. Third is the owner's equity. Fourth is the revenue, and the last is expenses. So now let's discuss these all head of accounts one by one. Assets. Assets we have already discussed in key terms earlier in this video, but let's have a deep look at that now. An asset is a resource with economic value that an individual, company, or country owns or controls with the expectation that it will provide a future benefit. Or you can say that anything that provide you future economic benefit either in short term or in long run. The assets have two categories, that is the current assets and the fixed assets. The term which we used a while ago, short term and long term, will decide the category of the asset. Short-term assets are current assets and long-term assets are the fixed one. Current assets are the liquid assets that can be convertible into cash within 12 months. We have already seen the example before also, but let's see another one. So the examples are cash in hand, cash in bank, account receivable, prepaid expenses, and the stock. On the other hand, fixed assets are those which provide you economic benefit for more than 12 months. So the examples you can take the building, the computer, the furniture, your car, etc. Now, the second one is liability. We use this in our normal life too in same sense which we normally use in the accounting one. A liability is something person or the company owes, usually a sum of money. Example of the liability is accounts payable, salary or rent payable, or any other payables. Accrued expenses, which mean itself the expense payable. So all those things will go under the liability. Even though in liability also there are long-term liability and the short-term liability, and the underlying concept is the same for the 12 months. So anything which is payable within the 12 months is the current liability, or there is anything which is payable for a long term, or which you can say for more than 12 months, it is called the long-term liability. Next one is owner's equity. So owner's equity is defined as the proportion of the total value of the company's asset that can be claimed by its owners, sole proprietorship, or in case of the partnership also, and by the shareholders. In simple word, equity, which means the value that would be returned to a company's shareholder. We can also say that asset is equal to liabilities. Asset minus liability is equal to owner equity. So that is the simple formula we can use also. So example of the shareholders equity is capital, which is invested by the owner, or if the company is corporation, then the amount invested by the shareholders. Retained earnings is also the part of the owner's equity. Fourth is expenses. Do not worry about that. This is same which you used by the layman too. Expenses are all those expenses which the company made for the generation of its revenue. Remember, the sentence company made for the generation of its revenue. So it means that any expense which is not helpful in generation of company revenue will not considered under the category of expenses. For example, owner does some expenses for his personal use is not expenses for expenses. You can put it in withdrawal or drawing by the owner. And the last one is revenue. Revenue means earning from the sale of the inventory. Any income which is not generated from selling inventory will be considered as income, but it will not come under the sale. So you have to keep in mind, bear this point in your mind. Now that we have covered all the head of accounts, we'll now learn about the rules of the debit and credit. We've already discussed that debit is just the left side of the book and credit is the right side of a book. So when the amount goes into the debit and when it went to credit, these rules will determine that. By looking into this table, you can easily understand the rule. So let's talk about it. It tells you that for asset, if asset increases, it will move to debit, and if debit increases and if the debit decreases, the amount will go to the credit. That is for the asset. Then for expenses, again the same as expenses. If expenses increase, it will go to debit, and if expenses decrease, then the amount will go to the credit. For revenue, it is different. So for revenue, we can say that if the revenue increases, it will go to the credit, and in case of its decrease, it will go into debit. Similarly, for liability, in case of its increase, it will be credit, and in case of the decrease, it's credit. So these are the terminologies, or these are the head of accounts, 5 head of accounts under which the whole accounting is being made. If you try to learn that, you will feel it a bit complex, and at the end you will mix it. If you want to remember it, just remember that if asset and expenses increase, then it will be debit, and if asset and expenses decrease, it will be credit. For rest, like for revenue, liability, and ordinary equity, it is vice versa. Means if rest of accounts increases, it will be credit, and when these accounts decreases, it will be debit. So to learn that, to keep that one or remember that one easily, just remember that if asset and expenses increases, then it will be debit, and rest you can automatically manage. How? You learned only one point. What is that point? If asset and expenses increase, it will be debit. So if asset and expenses are increasing and they are getting debit, it means in case of their decreasing, it will be credit. So from there we have already known. Now in the other head of accounts, we have already said that it will be the vice versa. So for example, for the revenue, owner's equity, or liability, if it is increasing, it will not come under the debit. It will, yes, you are right, it will be in the credit. And in case of a decrease, these terms or these heads will be debit. Now we jump towards reporting level. In reporting, major reports we have our profit and loss account, balance sheet, and cash flows. Cash flow is basically independent report and is not interrelated. whereas profit and loss account, which we also term as P&L, is basically dependent report, and it is dependent on all the data which we are getting from the main one. Initially, when we record transaction, it goes to the general ledger, which in short form we call it a GL also. For these, the figures goes to the profit and loss account and to balance sheet. All revenue expenses go to P&L, while assets, liability, and owner's equity goes to the balance sheet. This is the example we are showing you for profit and loss account and balance sheet. This will help you understand these reports. I hope this video will help you a lot in understanding the basic accounting concept. Please leave your comments in comment section below, and we will let you know if you want me to make video on any other topic. Thanks for watching this video. Do not forget to subscribe my channel and for more informative videos. I was your host 𝗧𝗯𝗹𝗲 Iqbal, and I will be right back with another exciting video. Till then, it's goodbye.